Hi everyone, and thanks for checking out my channel. I'm going to do some video about ETFs. I was meant to do this for quite some time, so couldn't find time to do it. And now I think it's probably a good time to explain a bit more how I do actually trade this. What are the pros, what are the cons, and give a few tips on how to actually make the most of these tools. So yeah, let's get started with the pro and looking at why I believe ETFs are pretty good products to trade, despite some cons that we are going to look later on. So the first one, very important in my opinion, is the regulated market. So most of the ETFs, or all of them actually, they are listed on a stock exchange, regulated, either in the US, like the US best, but in London as well, and even in Europe you can find them in Italy, I believe, on some of them. Yeah, I think that's a very important thing, so you don't actually have the risk or less risk of seeing your product disappearing somewhere, or your money vanished just because the broker took it away. You're actually buying an actual stock and you're holding it regardless of what your broker could be doing. So very important in my opinion. Of course, we're having low fees and spread. Depends of course where you're buying, but in the US usually the fees are between around $1 buying, sometimes it's even free, and the spread is usually reasonable if you buy it at the right time, so avoid high volatility. We're looking into the tips later on, but the spread is usually, I mean, 1% is usually average. It can be a bit higher when you're trading leveraged products, but it's usually quite reasonable. It's relatively easy to buy and sell, of course. It's just like a stock. Quite simple really. I don't have to bother about any complicated stuff. It's just you buy the price, selling, and with the spread you can easily calculate when you get out and in. They're actually also holding the real contracts, so as we can see, for example, that one is the UCO ETF that's trading crude oil, and you can see here they're actually spreading between the future February contract, June and December next year. So they're having a sort of a spread that's actually quite recent, following the big crash we had this year on oil. They did actually spread the contracts a little bit further away to avoid that kind of high volatility. But yeah, you're actually holding the contract at the back, so again, the broker cannot do what they want. They need to follow somehow what the price and what the market is doing. Sometimes can be a little bit complicated for the calculation, and you can see very different return on the ETF compared to what the front month's contract could do. If you're trading commodities, for example, you have to take into account that other contracts might move in a different way than the front months. But anyway, as long as you're aware of this actually, I believe, a good thing that's actually holding something real. Of course, in terms of gold and all this market, they're still not holding physical, but still holding future contracts is still, in my opinion, better than just making a bet against someone. Link to this, no margin requirements, you don't have to care about this, and there's no forced leverage, so you can choose a wide range of products. Used to trade Pro Shares in the US, so having many, so that's mainly for trading oil, natural gas, gold and silver. You can choose your leverage. Usually it's about 2 times leverage, and I believe we also have quite a few without actual leverage. If I take it away, my update. But yes, they're having a range. You can trade without any leverage as well, so you're not forced to trade 100 times leverage, that kind of thing that's requiring you to have a major or big margin requirement. That's a big pro in my opinion, that you don't have to care about this, and you can choose your leverage. Of course, you're limited to 3 times, but most of the time you don't want to trade more than 3 times leverage on commodities and future contracts. That's already quite a fair of an exposure anyway. That's linked to this is a low maintenance, so you don't have to worry about rollover. We can see that also counts in some instance, but when you move from one contract to the other, you just see the ETF will actually start rolling over a fair amount of time before the rollover time. But that's actually a worry not to be concerned about. Of course, the price will get impacted by this, but that's a different thing, not linked to the product. And finally, there's a large choice of ETFs you can choose from. I've looked at the ProShares, but I like to trade Wisdom Tree because they also offering many more products. So I'm not trading oil, natural gas, silver or gold here because they are not really interesting. If you want to take a bit more leverage, but the cost is usually a bit higher. The spread is also higher on this, and the decay linked to the leverage is not necessarily such a good thing. But you have access in the many more markets, such as coffee, for example, platinum, palladium. There's also all the agricultural with, and also I believe soybean somewhere at the bottom. Copper, sugar, so it's quite nickel as well. Limited options in terms of the shorts. They did actually reduce the number of short opportunities last year, or was maybe earlier this year, but they did actually remove a fair bit of shorts. So, for example, coffee is not shortable anymore, and there's many more markets you cannot short. Sugar, I think, is part of this. So a bit of a limitation there, but yeah, I mean, you choose the market and the swings you want to take. Yeah, just based on this. So now looking at the cons, there's of course a few things you need to be aware of. The first one, I believe is very important, is the delisting. It's been very much happening in Europe with Wisdom Tree. You have to be really careful with this. Usually they delist at the worst time, of course. So say you got a crash on the ETF and they force you to actually sell at a very low price. That happened a couple of times, especially with oil this year. You have to be really careful on this. So I will give some tips how to avoid this, but basically you don't want to hold this at the bad time. I mean, of course it's not intended, but sometimes you think the price will rebound, you keep on keep that position open, hoping for the price to move to the upside, only to see that they will actually delist and force you to sell at the worst time. So of course you can still buy back another ETF, but sometimes on other products they are not available, so you're forced to sell and don't have any alternative to actually cover your loss. So it's a really annoying thing. Also, of course, the decay is very important. Got some illustration here on gold. So if you look at the 1 times leverage, that's the GLD in New York, that's been really following closely the price, and you can see if you bought here at that level, you can see that it's been almost flat. You're not losing anything on your ETF if you've been holding since then, despite the price being pretty much at the same time. If you look at the same on the LBUL in London, so that's a 3 times leveraged ETF, so the price at the same time was sitting here 32.8% up, and then at today pretty much flat, you're sitting at 31, so you're losing basically 1 to 2% on that position just alone, just because of the time. So that's since July, so it's a fair bit of time. It's not, you can get much worse decay with high volatility commodities such as natural gas, for example. The decay is very impressive. You have to be really careful, but still, even with gold that's relatively stable, not moving too much, you're still losing 2% over a few months. So over a year you're losing between 4 and 5, so it's definitely not the right tool to hold. You need to actually time your entries really really carefully. Of course, linked to what we had before, so the low maintenance, you don't have to worry about the rollover, but the downside is that they can actually force you to roll over. They will actually roll over when they want, and they could roll over at a very bad time. For example, when the price has actually crashed, they will roll over to the next contract. That could have a very bad impact. For example, I think that happened on natural gas last year. We had a very big rollover gap. They did actually roll over at the worst time, and we got the terrible price, and of course big impact on the price. So yeah, that could be problematic. You have to anyway trade according to the rollover time on future contracts. Liquidity risk, that's a little bit not so much of a concern for the US, usually selling very easily, but on Wisdom Tree you have to be really careful. These products sometimes can just not sell. So be aware of this. If there's a big crash, something happening, the price moving fast, they don't actually find the counterparty to actually buy it back. They will not necessarily buy themselves, so you can be left with the open position and the price falling sharply. So you have to be really careful with this. Again, it comes down to the trading strategy. I will give some tips later how to avoid to get into this trap. You need to be aware of this. That's linked to this. There's no stop loss guarantee. So if they cannot find the liquidity in front of your position, they will actually not trigger the stop loss. So you're not actually protected. Even during the trading session. That's another big cons, of course, on ETFs. You're only trading during when the stock market is open, which is not covering when the commodities are actually trading. So of course you cannot do anything about the gap up, opening or down, but still you cannot even trade all the time during some time. So for example, if you're trading ETF in the US, you have to wait until the Asian session is almost done, but sometimes the price can be moving during that session, so you can do nothing about it. So again, comes down to the strategy and what to do to avoid being in that kind of situation. So yeah, it's pretty much what I wanted to cover. Just having a look now at natural gas. You didn't have a look at this, but look at how the BOIL, which is 2 times ETF tracking natural gas, has been actually moving, and you can see that from here on natural gas you move from 48 to 0.5, so it's a massive move to the upside. Of course, a lot of gap in the middle, and you can see that the ETF did actually not move that much. It was quite only 20%, so it's not even 1% leverage on this. So of course the rollover is taking a big take on this, but still it's just showing you that with all the volatility and the move to the upside and down, the decay is actually impacting quite badly the performance on the ETF. So it's definitely not made to hold long term. So I'll give a couple of tips now that I believe could be useful. So yeah, let's get started. So the first one, I believe, is you need to avoid trading at time where these ETFs are actually quoting badly. So typically one of that time is at the moment when you're actually having an opening. So that's definitely not the time you want to trade. Usually the spread is much wider, so you have to wait for the stock market to open to see the commodity moving a little bit, and then you'll see the spread shrinking very quickly. Also, peak of volatility, avoid trading, closing, buying at that time. Usually again the spread is increasing when the volatility is picking up, so you don't want to trade at that time. And when you want to close the position, always close it at a quiet time when there's no moves and you get the low spread and the price not moving too much. If possible, but of course for all the market it is not, avoid London ETFs. So the Wisdom trade, they are great to trade other markets, but they are more expensive. They usually run yeah, about the fees, I didn't put that down, but in the US you're having usually $1. If you trade in London, one buy is usually 5. So that's quite a difference. It's $10 open and close of one position, $2 on the US. It's of course 5 times more expensive, so you have to be really careful and not using that one too much, otherwise you'll be having some really major commission fees at the end of the month. So I'm trying to avoid this as much as I can. But of course if you want to trade coffee, for example, or sugar, you don't have a choice, but then you need to choose your entry points wisely. Which is coming down to my main tip, which is quite obvious, but you need to have a very solid trading strategy in place, so you can actually buy the right levels and don't get stuck with this and risking, especially more important, I believe, all this. The trading windows is a big risk in my opinion, so you want to avoid this and be safe with your positions. You don't actually need a stop loss. You actually always have a stop loss, but it's a manual one, so you will trigger when the quotation will resume on the day after. You don't have to stress about getting the stop loss triggered or not by basically buying at the right time. So it's a little bit linked to my strategy of reversal. I always accumulate position before the reversal happens, and I always accumulate before the breakout or the breakdown. I know this is contrary to what most of the trading people will tell you. They tell you to buy breakout, to buy breakdown. That does work on some markets, but for commodities and future contracts and you're trading ETFs, be really careful with that strategy. Is to really sure thing to get actually burned quite badly should you actually get into some forge breakout and all these things. So yeah, the trading strategy is very important here. Of course, I give some tips as much as I can in my videos on that channel. So yeah, you feel free to follow me on this. And finally, be careful with the leverage. 3 times leverage doesn't look like much, but it is actually on future contracts quite a lot. 3%, 4, 5% move in one day is very not uncommon. 3 times leverage, that's triggering 10 to 15% move in one single day, so it's not so small. And of course, if you get 30% going against you, your position is gone, as it is pretty much 100% of your position that is triggered. So if you want to hold no leverage, that's the first thing, and you need to of course link that to the proper trading strategies. You don't actually hold something that is losing too much in the long term. So yeah, that's about it. I wanted to cover about ETFs. If you have any questions, something I left aside, you just put a comment, be happy to answer. Again, follow my videos if you want to get a better idea about the trading strategy, and just don't buy or sell these ETFs just blindly. That's a bit risky, even if it does look less risky than the CFD. It's still carrying a fair bit of risk. So thanks for watching, and I speak to you soon. Cheers, bye.